All right, so women's fashion brands. I have a very interesting topic to cover today on raising your prices for your items. So, this is usually a topic that's it comes with a lot of fear and hesitation, but here I will address with you why exactly raising your prices actually does your brand more good and profit in the long run. So my name is Brandon. I built and sold a women's fashion brand with my partner Erwin, and ever since then we've been helping other women's fashion brands grow online from 1 million, if you're doing at least a million, to 2 to 4 plus million in online sales efficiently, attract more new customers, and increase their profit margins. Here are the results that we've gotten for women's fashion brands. These are 2023 results. More in this document in the description or the post. These are 14 plus women's fashion brands that we've gotten results for and work with. These are just some of them. And these are many of their testimonials of what it's like working with us from women's fashion founders such as yourself. So this document is very in-depth, but for this topic, we'll just cover raising your prices. Because raising your prices often comes with hesitation, nervousness, and some fear. What if less customers buy? What if they start complaining or posting negative reviews about us? Oh no. So why should you raise your prices? There's a segment in your market right now that makes decisions based on premium price. If it costs this much, it must be good, right? That's their thinking. It's a shortcut to buying decisions. It may seem counterintuitive at first, but it offers a lot of advantages to increasing your bottom line and making your business much more efficient. How? Let's dive into it. It lowers your return rate. Many consumers nowadays are spoiled. Free returns, free delivery, discounts every week, pay now, buy later, etc. I'm sure you know Klarna, all this. They expect everything. There's nothing bad about Klarna. I'm just giving you the context of what's happening in the market right now. They expect everything for nothing. This has led to increased return rates because there's significantly less commitment financially and emotionally from the customer. They buy with virtually no risk and return like it's no big deal. It's bad behavior. And also another side note, obviously in the current market conditions right now, at the time of this recording, this recession, return rates are naturally higher because customers are more second guessing. But this is just these principles and what I cover here will generally also still lower your return rate. The average return rate in fashion is roughly 50%. That means 1 in 2 customers are at a loss, which is absurd because returns just eat into profit margins. It costs brands a lot. When a product returns, you have to pay the staff to reprocess it, repackage it, and then put it back in its section. Then another customer buys it, and the staff has to do this whole process again. Yet the customer can potentially return it, therefore repeating this process again. And that just gets worse. At volume, this costs a fortune, right? If your return rate is super high, like the average, like this cost is crazy. Now, how do you eliminate this? By raising your prices, you actually price out this segment of unprofitable customers. It cuts your return rate down by a lot. Now, you may receive some complaints and backlash and your sales volumes drop a bit. Oh no, but I don't want my sales to drop. At the end of the day, they weren't going to be profitable in the first place. You may miss the excitement of seeing sales number go off on your phone, like ding, ding, ding purchases, right? But their purchases don't give you any long-term benefit whatsoever. So why stress over it? Why create more stress for yourself and your team? You are much more profitable now because you aren't dealing with this segment of buy return customers if you cut them out. Customers who buy at higher prices are less demanding and rarely will return products. They understand value better. And a quick tactic you can use to discourage customers from returning is by not offering free returns. This makes the customers more conscious in choosing the right one for themselves and not eat into your profit. Second, it decreases your back-end costs and makes it more efficient. This applies year-round, but especially for Q4, which I will use as an example. Black Friday and holidays is arguably one of the most inefficient periods in women's fashion e-commerce and just e-commerce in general. Many brands do it for cash flow and not make much profit, or even any profit. Shipping out hundreds and thousands of inventory costs an arm and a leg, sometimes even a kidney. You have to account for staff, returns, everything. You have 3 days of trade and you're shipping out multi-5 to 6 figures plus worth of inventory. You may need staff to work overtime or even bring in temporary staff in. And with rising costs thanks to inflation, agency and employee fees, this stacks up. But by raising your prices, you can counteract this because a trickling effect occurs. Because remember, by raising your prices, you are pricing out the lower end of the market, which means you have less inventory to deal with, which means less staff required, which means less requirement on temporary staff, which means less customer service staff, which also means less returns, right? One of the biggest costs that decreases profit. Naturally, when you increase prices, your volume lowers, but you net around the same, if not more profit, and take on less risk. You buy inventory to hit the same top line sales because you are at a higher price. With inventory, you will get less returns, which means you need less staff and processing. Your top line sales may not be as fast growth, but your bottom line will experience significant growth due to efficiency. Efficiency is the name of the game. I can't stress this enough. Efficiency over your ego. Right. So, third, you can deliver more value and grow. Let's look at two hypothetical scenarios. Scenario A, your cost to make a product and to ship it is $50. You sell it for $80. You only have $30 to run the rest of your business and provide value to your customers. You don't have much room. Scenario B, the total cost is still the same, $50. But now you sell it for $160. You now have $110 to deliver 2x, 3x, 4x the value to the customers and give them an amazing experience. Your packaging and unboxing and shipping experiences are better. You attract better customers. You can reinvest into your products to grow up the quality. You can advertise and market more aggressively. You can hire better talent for your team and to keep it lean and mean. The list goes on. Now, a quick note on talent and team efficiency. Talent may be more expensive, but the value they bring is worth 10 times what you pay them. One talented member can do the jobs of 5 regular members, reducing your stress management, your overall stress and mistakes. You want to know what's expensive? Hiring mediocre people that stagnates your brand or damages it. Setting your progress back. Then you have to bounce back and then find the talent to replace it. Huge opportunity costs. You already have talented people on your team. Ask yourself, how can they be more efficient in their work to produce more results? Can they handle more responsibilities? These are great questions to ask yourself and analyze instead of hiring a bunch of people when it can be done with your current team. Only expand in any part of the business once you've maxed out the efficiency. Circling back, women's fashion brands who increase their prices in a recession are growing because the customers receive more value. They attract and capture the higher end of the market. Like mentioned in trends, customers are now more conscious and picky with who they spend money with. They want to receive the value and experience from a brand who gets it. The customers who buy for value on your brand won't mind. They will spend despite the price increase. These are the ones you want to attract more. And fourth, you increase emotional investment and perceived value. No one bats an eye when they spend a couple bucks on coffee or cookies or whatever, right? Or like M&Ms. The price doesn't warrant a high emotional investment. But the more a customer pays for a product, the higher their emotional investment is. They value it more. I'm sure you experience this yourself with any purchases you made that were more on the premium pricing side. If you spend $60 on a vest from Zara, you probably won't care as much compared to spending $3,000 on a vest from Loro Piana. Right? And on and on. It depends on what your tolerance is or your ratio, right? But the principle is the same. You'll take care of it more. You make sure it's clean, not creased. You may even feel better in it. There was once a famous study conducted in Stanford University in early 2012 using 3 bottles of wine at different price points: cheap, middle, expensive. Volunteers were invited to participate in the experiment. The experiment was very simple. The researchers had the participants try wine from 3 bottles, from each of these bottles, right? And were asked to rank them from favorite to least favorite. One was the cheapest, second one was in between, and the third one was the most expensive. When the results were in, the majority of participants ranked the most expensive wine as their most favorite. The middle price was the second, and the cheapest as the last. The researchers asked, why? The participants then went on into a detail of describing why the expensive wine was their favorite. Undertones of burnt chocolate, oaky richness, I can taste the history, etc., 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 right? Not that surprising, right? Except what the participants didn't know was that all 3 wines were the same kind of wine. The only difference between each wine is the price point. What's even more interesting? While they were trying the wines, they all had MRI scanners on them for the researchers to analyze their brain patterns. What they found was that the part of the brain that was associated with pleasure was more active the more expensive the wine was. So in real time, because of the price difference, participants value the highest priced wine the most, even though the wines are all the same. What this means is the price subconsciously influences the participants. That the more expensive the wine is, the more special and different it is than the others, even if they are the same. So the more a customer pays, the more they value it, the more they enjoy it. So why would you want to rob your customers of the pleasure of buying something more premium from you? Ask yourself that. All right. If your product is as good as you think it is, you can raise the price and it will still sell. This is the true test to see if your products are valuable to the market. If it is quality and of value, customers will still buy 100%. Naturally, you'll lose some customers, which are typically the buy and return ones, but you won't lose many. Losing these customers and some volume in exchange for efficiency and profit will always be worth it because profit is what matters at the end of the day. Now, how much should you raise your prices by? Women customers don't mind paying more, but not too much more where it's just way too expensive and in their eyes, and it just takes away the spontaneity, right? Because you want impulse purchase. This principle applies, not impulse, but spontaneity behavior. This principle applies to all price points, whether your current AOV is $90, $180, or even $500 plus. You can always stretch it, but just not too much. This comes down to testing, but a good way to start is to gradually increase the price and see how sales activities go. You may see a temporary dip in sales when you increase. That's normal, because remember, you are culling the buy and return customers and pricing unprofitable customers out. If sales are consistent and are growing after a couple of weeks to a month, that's a good sign. Then increase it again. A gradual scale you can follow is to increase their price by 20% each time of the original price. Example, raise prices by 20%, then raise prices by 40% of the original price, then raise prices by 60% of the original price. Eventually, you may push to a point where conversions start to drop or sales stagnate way more before when you were raising it. Those are usual signs that it may be too high. If in that case, reduce the price back one step back and then see the activity. If it picks up again, that is your current sweet spot for the prices. So the bottom line is revenue is vanity, profit is sanity. Just drill that into your head. All right. So you can see how there's so many advantages to raising your price that it just makes sense. It doesn't make sense to not raise prices, right? Because then the higher end of the market are willing to pay more for value. And if your products are actually of value and good, they will buy even if you raise their price. All right. So I cover more of this in our social media channel, YouTube channel, and more in this document, which you can find in the description and our post. And if you're a women's fashion brand that's doing at least $1 million in online sales a year, that want to grow to 2 to 4 plus million in sales efficiently, attract more new customers, and increase your profit margin, just book a time with me, and then we'll dive more deeper together and just structure a win-win partnership. We work on performance basis, and we pretty much guarantee profit. Meaning, if you're not profitable from ads at the end of each month, after ad spend and our performance fee, which you don't pay up front, then you don't even pay the fee. So there's literally no risk for you. So this is only for women's fashion brands doing at least $1 million a year. So if you're interested in that, book a call. I look forward to speaking to you then. If you want to explore more content, I have plenty of other content on our social media channels. So if you're going to book a call, I look forward to speaking to you very soon.